So students, last class we were discussing regarding insider trading. Okay. So now I gave an introduction how insider trading happens in country like ours, right? So insider trading is getting that key piece of information based on which you make your you take a decision whether to buy these stocks or to sell the stocks. Say if you're getting a positive information, you buy the stocks of that particular company, right? And then when the share market price increases, then you sell and make a profit. Similarly, when you get a negative information, you immediately sell the stock at you immediately sell your stock, and then prevent yourself from loss. Because say today Monday you got the information, and today the stock price is at 400 rupees. So immediately you sold the stock at 400 rupees, and 2 days after there's a press meet, and then they'll inform that so and so thing has happened in some bad news, and then the stock price from 400 rupees crashes down to 360 rupees or 365 rupees. So there's a loss, right? So there are people generally in India. This board information is generally leaked by peons, by this particular attenders. Now, who happens to gather the information and give it to the bookies, or they happen to give it to other people, stockbrokers. Now, that's how Harshad Mehta was manipulating, and Harshad Mehta's market grew for a for a certain period of time, and that's what we happen to see in the series made, the scam 1995, right? So insider trading has been a very long time, and there have been instances where people happen to use this insider trading to topple the management also. Now L&T had a cement business for a very long time, and L&T wanted to L&T they thought that since their core business is construction, now cement will be a shot in the arm, right? It's going to help them for the construction, for almost all the constructions. Now the primary raw material or the primary ingredient is cement, so it made sense for their business to have their own cement plant. Now one of the stakeholder in that particular organization, L&T cement plant is called as Unitech, and one of the stakeholder in Unitech and arm of L&T is Kumar Mangalam Birla. Right. So he is also one of the investor in that, and one of the member of the board. Now, Mr. Birla cement organization, Grasim. Now they are very popular, and Birla Cement Birla company is one of the market leader in Indian cement business. So he asked him. So in order to expand his particular business, and in order to see growth in his business, he asked the board, L&T board, now why don't you sell your cement business to me? Why don't you make me the majority stakeholder? No, L&T did not accept that. Right. Now, when L&T did not accept that, now he started resorting to unfair means, and one fine day he became the board, chairman of the board. All right. Now here, insider in India, as per law, insider trading is prohibited. Insider trading is a crime. Now the Security Exchange Board of India, which looks after the stock market or the watchdog of capital markets, does not entertain any form of insider trading whatsoever. It's strictly prohibited. Right? It is illegal when information is still not public. Insider trading is the buying or selling of a publicly traded company stock by someone who has non-public material information about the stock. Material information is any information that could substantially impact an investor's decision to buy or sell the security. Non-public information is that information which is not legally available to the public. And insider trading can be legal as long as it conforms to the rules set forth by the SEC. Right? When insiders, that is the key employees or executives who have access to the strategic information about the company, use the same for trading in the company's stocks or securities, it is called insider trading, and is highly discouraged by Securities and Exchange Board of India to promote fair trading in the market for the benefit of the common investor. Insider trading is an unfair practice wherein other stockholders are at a great disadvantage due to lack of important insider non-public information. However, in certain cases, if the information has been made public in a way that all concerned investors have access to it, that will not be a case of illegal insider trading, right? Now, how does insider trading work? Let us take an example. Individuals who engage in insider trading attempt to benefit from trades based on information about a company not yet made public. For example, an executive of a company, say the company name is some XYZ, right? So executive of a company who purchases share of the company based on pending merger acquisition is engaging in insider trading, because when as soon as the information comes, now that executives may legally trade the shares based on the information. All right. So having access to that information which is not available to the public, and based on that information, if it's a positive information, if you're buying the stock, if it's negative information, you're selling the stock, is wrong. Now you take this buying and selling decision only when the information is made public. After informing the public, when you're taking the decision, it makes sense. Now, if you make that particular decision even before the information is made the public, then it's a crime. Now, and we have some rating agencies also. Now rating agencies or credit rating agencies are, now they are going to provide the credit worthiness, right? We have rating agencies for organizations. We have got rating agencies for stocks, and we have got rating agencies for even we have got rating agencies for economies also, right? Now there are certain organizations like Moody's now which happen to rate an economy. Now, similarly, we have got certain organizations which rate certain markets, which rate certain stocks. Okay. So now let's look at this particular rating. Now, what do rating agencies do? Rating agencies provide much information, much needed information to the investor, based on which they take a decision where to invest their money. Because these financial markets, especially the capital markets, all right, where we have trading of stocks, where we have trading of shares, debentures, bonds, now futures, all right. So wherever we have this particular thing, now in all such cases, now we need, I mean, this particular credit rating agencies, they provide the much needed information. They provide the much needed information to investor, where to invest, where not to invest, right? It's going to give him information based on which he has to take the decision. Credit rating agency will not say you take this decision, you invest your money in so and so stock. No, it's not going to say that. They will just give you the information. Investor, after having processed the information, now he has to take a decision. Information provided, and credit trading agency only provides information. Who has to process the information? Investor has to process the information. Based on the information provided by the credit trading agency, he processes information and then he takes a decision. Right. So many a time people make wrong choices, or people make wrong decisions, or they commit blunders or mistakes which are very costly and dear when they don't have access to the right information. It is in light of that, it is this and that particular juncture, credit rating agencies pitch in, where they provide the much valuable, much precious, much needed information to the investor, based on which he can take a decision. Now, with that particular backdrop, now let's look at the topic called rating agencies. Now, credit rating agencies have been around for the better part of the 20th century and have played a key role in the financial world by providing ratings on the credit worthiness of instruments in capital market. They can be stock, they can be bond, they can be debt instrument. Now, these ratings are invaluable tools for investors looking to get a better sense of whether debt instrument is worth investing or not. Therefore, when assessing the level of risk associated with a bond, investors will typically look at its credit rating. So basically, this credit rating agencies at this at the capital market level is they provide information on the debt instruments. So all those particular investors who wants to invest their money in debt market, now they look forward for the information provided by the credit rating agencies. Since most investors are looking for trade-off between risk and return on their investments, they are typically going to demand a higher rate of interest for bonds that have poorer credit ratings. As a result, credit rating agencies play an important role in setting interest rates on debt securities. Right. No, what actually is this credit agency? It is a company. It is a company that assigns credit ratings, which rate a debtor's ability to pay back debt by making timely principal and interest payments and the likelihood of default, whether they are in a position to pay back your debt or they are not in a position to pay back your debt. Now, this information will be provided based on which you can, it's a credit worthiness based on which you can decide whether to buy those bonds or not to buy those particular bonds. An agency may rate the credit worthiness of issuer of bond obligations of debt instruments, and in some cases of the services of the underlying debt, but not of the individual consumers. The debt instruments rated by credit rating agencies include government bonds, corporate bonds, municipal bonds, preferred stock, and collateralized securities such as mortgage-backed securities, collateralized debt obligations. Now, the issuers of the obligations or securities may be companies, or they can be special purpose entities, or they can be state or local governments, right? Or sometimes there can be an NGO or sovereign nations. A credit rating facilitates the trading of securities on secondary market. It affects the interest rate that a security pays out, with higher rating leading to lower interest rates and lower rating leading to higher interest rates. Individual consumers are rated for credit worthiness not by rating agencies, but by credit bureaus, okay, which issue credit scores, right? Now in India, we have an organization which rates the credit worthiness of an individual, right? So whenever you're taking any loan or credit card, you're borrowing anything from the institutions, they look at your score called as CIBIL. Now, what is the name? CIBIL, CIBIL score. Now, CIBIL is an organization set up by the government of India to rate the credit worthiness of an individual, right? So if you're now they are going to rate your credit worthiness on a score of 1,000 points. So if you're having points above 900, it means you're good. You're extraordinarily good, and then you'll be getting loans at very low rate of interest, and you'll be getting loans up to 90% or 95%, sometimes 100%. Now, say if your score is around 500, between 400 to 500, now not many people will come forward. Very few people will come forward, and they will lend you loan at a compounded rate, not at simple rate, at a compounded rate, and then you will not be worthy of getting 100% or 90% loan. They'll give you 60% of the loan amount, right? You see, the rating depends. Say if your score is more, which means to say you got more credit worthiness. The score is less, it means to say you got less credit worthiness. Now let us try and understand how credit rating agencies work. Debtors want investors to have a good idea of how credit worthy their securities are. Of course, investors are also looking for an unbiased idea of companies' ability to repay debt. Therefore, companies will often hire a credit rating agency to rate their debt. After the company solicits a bid, now the credit rating agency will evaluate the institution as carefully as possible. However, there is no magic formula to determine an institution's credit rating. The agency must conduct a subjective evaluation of the institution's ability to pay its debt. When conducting their assessment, now the credit rating agencies will look at a number of factors, including the institution's level of debt, its character, a demonstration of its willingness to repay its debt, and its financial ability, which is the most important one, and its financial ability to repay its debt. Although many of these factors are based on the information found on the institution's balance sheet and income statements, others, such as attitude towards repaying debt, they need to be scrutinized more carefully. For example, in a recent national debt ceiling debacle, S&P, now S&P happens to do the credit worthiness of nations. So S&P, Standard and Poor, we call it. S stands for Standard, P stands for Poor. Now Standard and Poor downgraded the US sovereign debt rating because they felt the political brickmanship of the federal government was not consistent with the behavior of AAA institution. Now AAA is the highest rating. Now, after AAA, AA, after AA, A, and then B, like that. So when they assess the institution's credit rating, the agencies will classify the debt as one of the following: high grade, upper medium grade, lower medium grade, non-investment grade speculative, highly speculative, substantial risk, or near default, in default. So on these particular areas, they are going to express the result. So wherever whatever debt instrument they say is nearby default, you're not going to invest money in that organization. You're not going to buy those organizations debt instruments. On the other hand, investments that are listed in as default are the riskiest debt instruments, as they have already demonstrated that they are unable to pay their obligations. Hence, investments in default will need to offer a much higher interest rate if they intend to invest money in them. Okay. Now there are certain advantages of credit rating agencies. Now one particular advantage is they help good institutions get better prices. Say if the attitude is right, if they are having the financial ability to repay, obviously those organizations will get better rates. Now similarly, for the investor, they are going to warn the investors of risky companies. Now those particular companies which are going to default, or those particular companies which do not have the willingness or the financial ability to repay the debt. Similarly, they provide a fair risk return ratio also, right? Okay, that also they are going to do. Okay, not all investors are opposed to buying risk debt securities. There are some set of investors who will be buying them, who will be buying high risk because they get more interest. Lower risk, low interest, but high risk, more interest. So in that greed of getting more interest, more money, they'll invest them. So their credit rating agencies will inform these people, these high risk investors, of the risk levels for every debt instrument, and then help and they also ensure that they are properly compensated for the level of risk they're taking. So their credit rating agency plays a very key role. Now they also give institutions an incentive to improve. Now a poor credit rating may be a wake-up call for the institutions, right? And they'll have to, or those institutions that are not demonstrated, they are willing to be responsible at paying back. It's a wake-up call. So these institutions cannot be in a denial mode for a very long time. They have to set their house in order. Now, similarly, there are certain disadvantages also. All right. So one of the major flaw, major disadvantages, evaluation is highly subjective. Now there is no standard, or there are no standard formulas or standard procedure for establishing an institution's credit rating. Right. Now, instead of, since we don't have a standard, or we don't have standard procedure, no, credit rating agencies, they use their best judgment. Now, sometimes they unfortunately end up making inconsistent judgment. Right. Now, for example, now taking the previous example, S&P downgraded the United States and lost its AAA credit rating agency. Regardless of this SSP, Standard and Poor's decision, the other two major credit rating agencies still gave US the highest grade point, grade rating. Right now, whom to believe? To believe S&P or to believe Moody, which is right? No, there's no consistency because there's no standard thing, and they make ratings based on their own judgment. Now, sometimes there can be conflict of interest also. Now, the credit rating agencies usually provide ratings at the request of the institutions themselves. Although they sometimes conduct unsolicited evaluations of the companies and sell the ratings to investors, they usually are paid by the very same companies they're rating. Obviously, when the company is paying a credit rating agency, it also tries to determine its rating also, right? Because they are taking money, they'll have to do something in return. So there is the conflict of interest. No, ratings are not always accurate, right? So many times ratings backfire, ratings go haywire, right? Now, interestingly, when the United States had its debt downgraded, the financial community was surprised that more investors flocked to US treasuries than ever before, right? When Standard and Poor has downgraded this US securities, right, treasury from AAA to AA, now more people started investing money in that. More people started buying debt instruments from the US treasury. All right. Okay. Now that again, so the ratings are almost not accurate. Now let us look at the benefits of good corporate governance. Now, good corporate governance ensures success and growth, which all of us know. Now, strong corporate governance organizations they maintain investors' confidence. As a result, company can raise capital efficiently and effectively also. And other most important thing is when we have good corporate governance, it lowers the capital cost. And there's always a positive impact on the share price. So the share price never depreciates. It only keeps appreciating. It only keeps increasing, thereby generating wealth for the investors. And it also provides proper inducement to the owners as well as the managers to achieve the objectives, right? By when organization, when these particular people who are managing the show or running the organization, they achieve the objectives, now they are meeting the interest of the shareholders in the organization. Now, other important thing is good corporate governance, which is required in today's corporate world. It minimizes wastage, it minimizes corruption, minimizes risk, and most importantly, minimizes mismanagement. So many organizations today are becoming bankrupt because of mismanagement or else corruption. Now, both these things it is going to minimize. It also helps in brand information and development. Now, where we have corporate governance in place, now the brand equity starts increasing. Now, finally, it ensures organizations are managed in a manner that fits the interest of all the stakeholders: interest of investor, interest of employee, interest of management, interest of customer, interest of public, suppliers, debtors, creditors, all these particular people. Now, let us look at some of the corporate governance reforms. Now, some of the significant changes have happened. For example, now one of the major corporate governance reform is aligning listing agreement with the Companies Act 2013. Now, this as per this change, Companies Act requirements on issuing a formal letter of appointment, performance evaluation, and conducting at least one separate meeting of the independent directors each year and providing suitable training to them are now included in the revised reforms of SEBI. Now, similarly, independent directors are not entitled to any stock option, and companies must establish a whistleblower mechanism and disclose them on their website. Now, similarly, restricting the number of independent directors. Now, previously people had more independent directors, right? Only to interfere into that, say, only to interfere into their particular businesses, right? This by sometimes this independent director act as moles. They do some dirty work like spy work. They spy on that particular organization, give the information to other investors. Now, this sort of dirty tricks are being done. Now, thanks to the involvement, so the number of these independent directors has been restricted. Now, as per the clause 49 of the Companies Act, The maximum number of boards a person can serve as an independent director is 7. Now, beyond 7, he cannot. In each and every board, he cannot be an independent director. He can be independent director up to 7 companies. And in 3 in case of an individual also serving as a full-time director in any listed company. If you are serving as a full-time director in a listed company, it is 3. If you are not serving anywhere, then it is 7. The Companies Act sets the maximum number of directorships at 20, of which not more than 10 can be public companies. There are no specific limits prescribed for independent directors in the Companies Act. Although SEBI reforms seem to be moving in the right direction, these limits may initially pose challenge in sourcing qualified independent directors for listed companies. Now, similarly, the maximum tenure of independent directors, based on the Companies Act as well as the new equity listing agreement, an independent director can serve a maximum of 2 consecutive terms of 5 years each. That is an aggregate tenure of 10 years, not beyond that. These directors are eligible for reappointment after a cool-off period of 3 years. Now, take a break of 3 years and again you can be on the board. But continuously, no. Those days are long over. Those days are gone. Right? It is not anybody's fiefdom. All right. It is not anybody's private property. Like now, you can start owning. It's not your own private business. Like it's there for you for years and years. No, not acceptable as an independent director. Maximum 2 tenures. After 2 tenures, now take a break and then be back if you are if you still want to continue. So the question is, can a director who has served 2 5 terms, like for 10 years continuously, be considered independent after a full period of 3 years? Now, for the answer for this, the CFA Institute recommends that board members limit their length of service on a specific company board to no more than 15 years. All right. So even if he's going to continue another 5 years, that's it. Not more than 15. Once you completed 15 years, you are done and dusted. Route. And then they encourage new people with fresh ideas and new ideas. Next, board mix criteria is again redefined. Now, as per the clause 49 of the equity listing agreement, 50% of the board should be made up of independent directors if the board chair is an executive director. Otherwise, 1/3 of the board should consist of independent director. All right, if the board chair is an executive director, 50%. If the board chair is not an executive director, then 1/3. Now, additionally, the board of directors of a listed company should have at least 1 female director. There should be at least 1 female. While it is a welcome change that SEBI mandates a female director, will it make a huge difference to the effectiveness of boards? Now, for that, what CFA says is, the CFA advocates that diversity should be embraced from all angles, such as diversity of backgrounds, expertise, and perspectives, including an increased investor focus to improve the likelihood that the board will act independently and in the best interest of shareholders. No, so when with regarding to mandatory female director, now CFA said, now why only you are bringing in gender? We are looking for diversity, not just in gender, diversity in the background. We are looking diversity in expertise as well as in perspectives also. Now the role of audit committee is also been enhanced. Now the SEBI reforms calls for 2/3 of the members of audit committee to be independent directors, right? Now whoever are conducting the financial audit of the organization, now 2/3 members of that particular audit committee, they should be independent directors, with an independent director serving as the committee's chairman, right? Because when we don't have independent directors, the audit committee forces the auditors to manipulate, and thereby you are harming the interest of the stakeholders, different stakeholders, not just investors. Well, the Companies Act requires the audit committee to be formed with a majority of independent directors. SEBI has gone up a step further to improve the independence of the audit committee. Now, the role of audit committee has also evolved to incorporate additional themes from the Companies Act, such as reviewing and monitoring auditor independence, approving of related party transactions, scrutiny of inter-corporate loans, valuations, and evaluations of internal financial controls and risk management systems. Now, some more stringent rules are there for related party transactions. All right. Now, all related party transactions require prior approval of the audit committee. All material related party transactions must require shareholder approval. Now, this is revolutionary, right? Must require shareholder approval through special resolution, with related parties abstaining from voting. The threshold for determining materiality has been defined as any transaction with a related party that exceeds 5% of the annual turnover or 20% of the net worth of the company based on the last audited financial statement of the company, whichever is higher. Now, since SEBI clause 49 requires shareholder approval for all material related party transactions, so wherever you are having transactions, then shareholders should also be involved. With no exception for transaction in ordinary course of business or at arm's length, companies feel that this will result in practical difficulties, particularly for those that regularly transact business with subsidiaries. There are always bound to be some pros and cons. Improved disclosed norms. SEBI resorts to disclosure as an enforced tool. Listed companies are now required to disclose in their annual report granular details on corporate on director compensation. Now you should also provide information to the public on director's compensation, including his stock options, director performance evaluation metrics, and the director's training. Similarly, independent directors' formal letter of appointment or resignation with their detailed profiles and the code of conduct of all board members must now be disclosed on company's website and to stock exchange. Okay. Now, similarly, electronic voting mandatory for all listed companies. Until now, resolutions at shareholder meeting in listed Indian companies were usually passed by show of hands, except for those that required postal ballot. Now, this means votes were counted based on the physical presence of shareholders. Now, SEBI has also changed clause 35B of the equity listing agreement to provide e-voting facility for all shareholder resolutions. So people can always participate in this meeting electronically also. Now, enforcement. SEBI is setting up the infrastructure to access compliance with clause 49 to ensure effective enforcement. Companies need to buckle up and assess the impact of these reforms and step up compliance. And finally, industry impact. SEBI is boosting investor confidence through these sweeping changes, especially the potential to empower minority shareholders, that is like you and me. We call them as retail investors. Okay, minority shareholders through e-voting, enhanced disclosures on remuneration that is aligned with global best practices, and by requiring independent share owner approval for related party transaction. Now, all these things are revolutionary in the Indian backdrop. Given India's humongous need for risk capital, regulatory norms and better enforcement are critical for market integrity and building investor trust. So this sweeping changes brought through clause 49 of listing agreement now has been revolutionary changes that are enforced by SEBI. Now in the next class, let us look at the initiatives in India. Now I thank each and every one of you for having attended this class.